Welcome back to the Deep Dive, where we take a stack of highly specialized sources and really give you the strategic roadmap for what's happening in corporate America.
Yep.
Today we're doing a deep dive into Teledyne Technologies, TDY. We're not just looking at their financials, we're analyzing how a very specific acquisition strategy is defining their future.
It's a relentless focus, really, right on the highest end of the defense and space components market.
Okay, so what's our mission today?
The mission is to decode that strategic logic. Teledyne is, clearly choosing to concentrate capital in these high barrier to entry sectors.
Right.
And we need to understand how this aggressive approach, how it squares with the real operational and financial headwinds we're seeing in their reports.
Okay, let's unpack this. We have to start with the headline event. The acquisition of Micropac Industries, Inc.
Yeah.
This deal closed right at the end of 2024, December 30th. It cost Teledyne about, $57.6 million.
All cash. And for anyone who doesn't know, Micropac is a niche specialist. They make microelectronic circuits, optoelectronic components.
So the guts of advanced military and aerospace platforms.
Exactly. And what's fascinating here is that this wasn't just, an isolated move.
No, it wasn't.
It signals a sustained, really focused effort. Just weeks later, January 2025, they completed another key acquisition. Teledyne Qioptic.
Qioptic does the heads-up display optics?
Right, the visual systems in critical defense aircraft. So both of these purchases just push them deeper and deeper into what we call the AD&S high reliability sector.
So the big takeaway here is that Teledyne is spending cash to buy components for the absolute hardest jobs in the world.
Yes, the jobs where failure is simply not an option.
They are intentionally buying their way into the highest technical moats you can find, even while their own filings acknowledge some pretty significant market risks.
That's the tension we're exploring.
Let's zoom in on that target then. Micropac. It's a $57 million cash deal. Why this company? How does Micropac's technical expertise translate into, predictable long-term revenue for Teledyne?
It all boils down to technical specification and, honestly, technical debt for everyone else.
Okay.
Micropac isn't just making standard circuit boards. They're designers and manufacturers of custom, semi-custom, hybrid microelectronic circuits, power controllers.
So their use cases are mission critical.
Absolutely. Military systems, aerospace, medical devices, and crucially, space applications.
I saw the buzzword space grade referenced over and over.
Yeah.
For listeners who aren't engineers, what does that classification actually mean in terms of, barriers to entry?
The space grade element is pretty much the whole story.
Really?
Yeah. Micropac is a recognized supplier of hybrid microcircuits that meet MIL H38534 Class K requirements.
Class K.
Think of Class K not just as high quality, but as the absolute highest reliability level defined by military standards. It is explicitly for deep space.
And that means the components have to survive environments that are just brutal.
Brutal is an understatement. Give us a feel for that.
I mean, what are we talking about here?
We're talking about conditions that make the Sahara look temperate.
Huh.
Components have to operate reliably from minus 150 degrees Celsius all the way up to a scorching plus 125 Celsius.
Unbelievable.
They have to withstand immense vibration, shock, and years of unrelenting high-level radiation. If that component fails, your $500 million satellite is just space junk.
And the regulatory and technical moat built around those specs must be monumental. It's not just surviving, it's surviving for a lifetime.
Precisely. That longevity is non-negotiable, and that's the financial security Teledyne wants. AD&S platforms are designed to operate for 20, 30, sometimes over 50 years.
Wow.
So once a Class K component is designed into a platform, the switching cost to move to a new supplier is astronomical. It's revenue visibility locked in for decades.
That's what they're paying for.
That is what they're paying a premium for. Components that cannot be easily replicated or replaced.
Okay, so we've established the technical moat Micropac brings. Let's look at why this entire AD&S sector is commanding such huge premiums right now. Why is Teledyne focusing so intensely here?
Well, the sector is experiencing a massive investor rush toward these high-reliability solutions.
It's a feeding frenzy.
Basically.
Yeah.
Established providers attract premium valuations because of those high switching costs, yes, but also because the demand drivers are accelerating globally. Defense modernization is a huge factor.
And what about the specific submarkets?
That's where the growth is staggering. We're seeing huge, sustained growth projections for global drones, A compound annual growth rate of, 14.4% through 2030.
14.4, that's huge.
And then there's global hypersonics projected at 11.4% CAGR through that same period.
And all these platforms rely on the kind of perfection Teledyne is buying.
Utterly.
So let's contextualize the multiple. Micropac was acquired at 9.1 times EV to EBITDA. Is that high? Low.
And that's where it gets really interesting.
Okay.
Teledyne bought a top-tier asset, Micropac, at a relatively modest 9.1 times. Now, contrast that with some larger deals. Honeywell's acquisition of CES Systems was priced at a steep 14 times EV to EBITDA.
14.
And ESCO's acquisition of Ultramaritime's business was at 12.8.
So Teledyne appears to have gotten a relative bargain compared to those. But if we look at the publicly traded companies, the peer group, that gap gets even wider. Right?
Oh, it gets much wider. The median EV to EBITDA for publicly traded high-rel component providers, companies with similar moats, is much, much higher.
How much higher?
We're looking at a median of around 22.5 times based on 2025 estimates.
22.5. So there's this huge gap between the strategic buyer price, 9.1, and the public market trading multiple at 22.5.
Exactly. And that tension raises a big question.
Is Teledyne showing discipline by acquiring at 9 times, or are the public markets at 22 times just irrationally exuberant?
That is the crucial debate. Teledyne is clearly buying quality assets, but they're doing it at multiples that are far closer to Earth than what we see in the public markets. And they have the financial strength to do it.
Okay, so that M&A strategy is aggressive, it's targeted. Let's pivot to Teledyne's overall operational health in 2024. What's the financial foundation that lets them execute these big cash acquisitions?
They finished 2024 with tremendous liquidity. Their net cash from operating activities increased dramatically to almost $1.2 billion.
$1.2 billion.
Specifically, $1,191.9 million. That's up over 40% from the $836 million they reported in 2023.
So that translated into over $1 billion in free cash flow.
$1,108.2 million to be exact. Massive cash generation.
And that's not just funding M&A, it's also going back to shareholders.
Absolutely. The board approved a new stock repurchase program in April 2024. They authorized up to $1.25 billion in common stock repurchases.
A huge statement of confidence. But you mentioned headwinds. No company of this complex is without pressures. What were the key ones?
Well, the most notable pressure point, and the one that gives us a real insight into the macro environment, was a non-cash impairment charge.
Related to the FLIR acquisition.
Right. Teledyne recorded a $49.5 million non-cash impairment charge on the FLIR trademark in 2024. Essentially, its estimated fair value was found to be about 7% below its carrying value.
Okay, impairment charges happen, but what specifically drove that write-down? This is where the story gets critical.
This is where we connect the dots back to the cost of capital.
Yeah.
Management noted the impairment was triggered because they included an additional 50 basis points.
Wait, 0.5%?
0.5% of risk premium in the discount rate during their valuation process.
You're telling me a very modest 0.5% adjustment to the cost of capital was enough to trigger a nearly $50 million write-down on a major asset.
Exactly. It shows the incredible sensitivity of these large tech acquisitions to changes in the interest rate environment. Management factored in a slightly higher risk premium, and that tiny change immediately forced the impairment.
So beyond that internal modeling pressure, what other macro risks are they flagging?
The classics for this sector. Continued reliance on U.S. government contracts, so they're sensitive to budgets and shutdowns.
Sure.
They're still facing component and raw material shortages. And of course, increasing competition from low-cost Chinese manufacturers, especially in their digital imaging and instrumentation segments.
And on a governance note, we should mention the retirement of Charlie, a director for nearly 24 years. That kind of institutional wisdom is hard to replace. So what does this all mean for you? Teledyne is executing a well-capitalized strategy. They're cementing their position in critical, high-margin AD&S tech through acquisitions like Micropac.
Backed by phenomenal free cash flow.
Right, but the financial system is signaling caution. That's shown by the fact that even a tiny 50 basis point increase in rate assumptions triggered a $50 million impairment.
It's a dual reality. They have the capital and the vision, but they're operating in an environment where the cost of capital is forcing a brutal reevaluation of asset values.
Which brings us to our final segment where we stretch the limits of analysis.
This is not financial advice segment.
Purely for intellectual stimulation. Given this enormous gap between public multiples and acquisition multiples, what's your outrageous but plausible trade idea?
I see a significant arbitrage opportunity being highlighted by Teledyne's own data.
Okay.
The public AD&S component market trades at a median of 22.5 times EV to EBITDA. Teledyne, a very smart buyer, just bought a top-tier asset, Micropac, at only 9.1 times.
So you have the market consensus trading at more than double the private acquisition price.
Exactly. And you couple that with the FLIR impairment, which shows that a tiny 50 basis point increase in the risk premium can trigger millions in write-downs. The public high multiple companies are exposed.
So what's the trade?
The trade idea is to buy high-volume, long-dated put options on publicly traded AD&S component suppliers that rely on these extremely high multiples.
Like a TransDigm or a HEICO.
For example, you are betting that interest rate normalization continues, forcing valuations for the entire high-rel peer group down closer to the demonstrated strategic acquisition multiples.
So you're shorting the valuation gap.
Precisely. You're betting that the gravity of finance will pull that 22.5 times market median closer to the 9.1 times reality of strategic deals.
That is definitely a move for anyone paying attention to the fine print. And that detail, the 50 basis point trigger for the FLIR impairment, it raises one last provocative thought for you to mull over. If just 50 basis points of risk premium triggers a $50 million write-down on FLIR, what does that say about the sensitivity of Teledyne's entire AD&S portfolio and the massive goodwill on its balance sheet to a prolonged higher-for-longer rate environment?
That is the question that defines the true cost of their aggressive strategy.
Thanks for diving deep with us today. We'll catch you next time.